Okay. Well, welcome everyone, and thank you to this attending this special time, and thank you to our guest Glen Neely for making himself available at this probably what we would say an unsocial time in his part of the world. So thank you very much. We certainly do out here in Australia certainly do appreciate the ability, the opportunity to hear some of the top names in the market be able to speak to us directly and give us the opportunity to raise questions and to the presenter, to Glen, and sort of interact a little bit more in our way with his ideas. Glen Neely's been around for a long time. I read his book back in 1991. And for me, I found one little important piece of information, which was very important for me back then. So thank you very much, Glen. But he has taken the view of Elliott Wave to a new level, which he calls NEoWaves, which he'll be able to expand on a little bit more to us today. But before we go on, I'll just like to go through our disclaimer. Like you to note that the views expressed at this meeting are the views of the speakers and the members only. They do not represent or reflect the views of APTA. Under no circumstances does APTA endorse, approve, agree with, or promote the views of speakers or members. Speakers and members present their views for the purpose of education and the exchange of views and discussion only. The views expressed must not be acted upon as investment, financial, taxation, or legal advice, or any other sort of advice. Meeting attendees should consider the appropriateness of the views expressed in the light of their own objectives, financial situation, needs, position, and if necessary, seek the advice of a competent and licensed advisor before acting on it. So thank you everyone for attending. I'll just now hand over to David, and we'll allow David to drive it from here. Now,
thanks, John.
So I'll just stop sharing for a moment and go to David. And
you have to unshare your screen.
Yes. Okay, all yours, David.
Beautiful, thank you, John. Thank you. Now, I've had the pleasure of knowing Glen ever since I won I think I won a Mastering Elliott Wave book at one stage back in, might have been about 1991 or 2, and back in the Australian Technical Analysts Association. I think somebody came in. A book prize was launched. Oh wow! This guy has so much detail on Elliott Wave and so many rules that took it beyond where I had seen Prechter and Frost done. What I'd seen Prechter and Frost had done, and I thought this man has a very tidy, precise mind. And as I got to know Glen over the years through actually going over and visiting him in the States and bringing him over to Australia for doing seminars and things. He really has an ordered mind, and I can understand how he gets to the results that he gets in terms of being one of the best market timers in bonds and the S&P. I'm not sure about gold, Glen, but you might, I don't know, I don't follow your stats on gold, but he keeps on popping up in Market Timers Digest as being in the top 3 really consistently, unbelievably consistently. And he seems to do it with ease and very low drama. Very low drama. I don't know whether that, it's so consistent. So it really is a pleasure to have Glen speaking, and we're going to run free form. So if you've got a question, pop it up I'll be moderating it. Glen, John will probably pop in as well every so often, help me, because I'm not experienced on Zoom. But it really is a pleasure to have Glen here, and I've learned a lot from Glen over the years. And sometimes I've just gone, oh fuck, I'm just completely wrong because Glen thinks it's this way and I was thinking it's that way, and totally had to revise my thinking around particularly important markets. So, Glen, I want you to give, where did you start with technical analysis?
I want to point out one thing first. Apparently, I've impressed you so much that you spelled my last name wrong.
Oh, yeah, that was a spell check. There's no E. That's the spell check. Did I fix that?
Okay.
There you go.
Okay, much better. What was your question?
Where did you start in being really picky?
That was my mother's fault. My father died when I was 1 year old, and my mother had to raise 5 kids by herself with no help from anybody because all her relatives were 1,000 miles away. So she had to be unbelievably organized to be able to manage all that. And I think that's where that came from.
Wow. Okay. Well, it was a good question. Yeah. Wow.
Yeah.
Touching as well. Sorry to hear that.
Fortunately, she was organized. Otherwise, I'd had a pretty horrible life. And even more fortunate, she inherited money 5 times, so that didn't hurt either.
That will kind of help a bit. Not bad. Okay. So, when did you get interested in markets and technical analysis?
Well, I was actually working offshore in the old business on one of those offshore rigs that were floating on the water out in the Gulf of Mexico. And when I would go out, because there wasn't much to do, I'd bring tons of books with me on every imaginable subject. And I would study the 12 hours that we would work 12 on and 12 off. And the 12 hours we weren't working, about 8 or so of those hours, I would study and read on just about any subject imaginable. And the first major book that I came across on the stock market was called The Commodity Futures Game. And I read, it had like a synopsis of all these different kinds of theories and stuff. And when I got to Elliott Wave Theory, almost just the name sort of felt right. But when I read about it, I just instantly knew that's what I'd been looking for, because I'd been studying markets for about 3 years up to that point and could never find anything that really, struck home with me and made sense and really felt like the right thing. And when I read the description of it, I just knew that that was it. And it was what I'd been looking for. And I just took off from there, and I tried to find every book I could find on the subject, realized most of them were pretty mediocre, and that there was a lot of missing information. In my book, chapter 5 of my book is predominantly what is in all books on Elliott Wave, but my book is 12 chapters. So, I have the introductory chapter, and then I have the chapter 2, which talks about constructing data and how to plot data. And then chapter 3 talks about how to begin the analysis process. And chapter 4 talks about how to deal with degrees and stuff like that. And then it moves on to the traditional Elliott Wave stuff. And then chapter 6 talks about confirming patterns, and it just goes on and on. So I realized when I first started studying it, there was a lot of information missing, and I wanted to figure that out. And I also realized that as I studied, I started to know more than most people knew, but I still realized there was a lot missing. So I decided to start teaching classes. And I think I'm probably the first person in the world who started teaching wave theory classes and maybe market analysis classes over the telephone. And I did this I started this in 1983 or 84 or 82, somewhere around there.
Wow.
So I was 23 years old when I started. And to make it possible, I had to create these booklets where I would send the student identical everything to what I was using, identical chart paper, because you had to do charts by hand then, identical chart paper, identical data, identical books. I mean, everything was organized to the hilt so that I could actually speak to them over the phone and them understanding what I'm looking at and what we're talking about and so forth. So that's where I began my classes. And I did that for about 5 years. And from teaching those classes, every time I came up with a new idea, I would write it on an index card I realized something about wave theory. I realized a logical flaw or problem or something that made it better. And by the way, we're looking at you change the charts over and over. I'm not sure if you're aware of that,
Which is
David.
probably a bit annoying. I was thinking it was just showing this particular screen, but it's obviously not.
No, it's showing everything you're doing.
Yeah.
I can switch to my charts.
Yeah,
if
let's
you like,
switch to yours, and then you can then we can get
okay,
going.
hold
Yeah,
on one second.
that'll be prettier.
Let's see, hide video, exit.
That was one of the reasons.
Somebody's gonna have to give me the ability to. Oh, here it is.
You've got it.
Okay, green.
I'll stop share.
Yeah, I think you need to stop on your end so that I can then show mine.
I'm stopped. Yep.
I think this is it. We'll see what happens here. Okay, so let me know if you can see my S&P long-term chart. Do you see it?
Yes,
Your mic's
we
turned
can.
off, Dave.
Yeah, yes, we can.
Okay, so from that process of teaching, I started taking lots of notes, and I ended up with about 4 or 5 index card boxes of every idea that I came up with while I taught classes. And then in 1984, the Macintosh came on the scene, and all of a sudden you could actually write books and print out documents on a computer that looked just like what you were looking at on the screen. That was the first time that was possible. So you could actually write a book on the Mac and then print it out. And that's when I got the idea. I can write a book and I can actually do it on this computer. And I took all those index cards and went through every one of them and made sure every idea was included in the book. And I used a program called More, which allowed for unbelievable organization of the book. I mean, that was if I didn't have that, the book would not be nearly as well organized as it is. So that allowed me to make sure that all the concepts logically flowed from one to the next. And then I released my book. The first version was 1988, I think. And then I self-published. And then eventually I found a New York publisher, financial publisher, Windsor Books. And they started advertising all around the world. So that was what launched my Elliott Wave career and sort of established me as an expert in the field. And then, of course, I just kept perfecting it over the last 30, 40 years since I wrote the book. So I'm not sure if that answers your question, but that's how I got started with wave theory.
Brilliant. Thank you. No, I didn't know all of that. I knew you started young and talked about Dow at 10,000 when it was at 2,000, I think. So
yeah, I was also talking about Dow 100,000.
That's true.
When it was at 1900. You
Not
do realize
bad.
that's in the back of my book, right?
Yeah, I do. I do. The 100,000 is in the back of the book. Well, we're nearly there.
Well, I mean, we only have to double 2 more times and we'll be there, right? So the target date for that is around 2065. It might be a little early, but that's still my target date.
Maybe I'll be around then. I think I'll be 105. Yeah. But anyway.
Wow. Well, technology keeps getting better.
I know. My friend keeps telling me go for 100. A guy called David Sinclair in Harvard or Stanford or somewhere. He says you can get to 120 pretty easily. It's like, I'm not sure my knees will handle that. But anyway.
Yeah, exactly. Well, they might have regenerative medical technology by then.
Yeah, get a new knee. Okay, seeing as we've talked about Elliott Wave and your adaptation, why is that not a 5th wave that you're talking about on a neutral triangle that we're looking at?
Okay, that's a good question. It all has to do with the concept of confirmation, pattern confirmation. So under traditional Elliott Wave, time is really not an issue, and post and mostly post-market pattern behavior is not an important criteria either. So you could have a high and the market can just meander down, and as long as it looks like a high, then that's the end of the pattern. Most wave analysts start a first wave right off of any low, and if you go through a correction, it's always wave A. There's quite a few problems with that approach to market analysis, because psychology doesn't necessarily conveniently become bullish right at the low or bearish right at the high. Patterns have to behave in certain ways to confirm that they're what you think they are. So what really differentiates NEoWave from Elliott Wave is a logical construction to NEoWave and very specific confirmation rules that have to, behavior confirmation rules that have to be met. So if you have a 5-wave move, the minute the 5-wave move is over, there's specific requirements for how the next correction, like wave A of the next ABC, how that A wave and ABC must behave, how much time it should take, how far it must drop, how quick it must drop, and so forth. And if you don't produce that behavior, then what you thought was a 5-wave move actually wasn't, and it's something else. So in this particular case, we're dealing with a 5-wave move with the 5th wave the longest, and 1 and 3 are more similar. 2 and 4 are alternating to the extreme here, where you have a very complicated 4th wave, very simple 2-wave. But the critical event for confirmation is what happens after the 5-wave move. So we have this 5-wave move ending, and to confirm that that your analysis might be correct, it doesn't mean it's absolutely correct, but that it might be correct, the first thing that has to happen is you have to break the 2-4 trend line in less time than wave 5 took to form. So if I were to measure the time of wave 5 here, from its touch, where it touches the trend line is where the 5th wave has to start. It can't start before the touch. Otherwise, you're dealing with corrective action as part of wave 4. And that's why I don't have wave 4 ending down over here, because if we do that, the trend line is broken repeatedly over and over during the advance. So, well, not repeatedly, but at least one time it's broken. You have to have a clean trend line between waves 2 and 4 to be legitimate. Let me move this back. So when you look at this 2-4 trend line, you can see it touches wave 2 and touches the end of wave 4, but nothing else. And then no part of wave 5 touches that. So that helps to define this as a clean, potentially official 2-4 trend line and potentially a 5-wave move. So once it's over, to confirm that it might be right, or that the odds are a lot better than average that is correct, you need the reaction after wave 5 to touch this 2-4 trend line in less time than wave 5 took to form. So you can see this is the amount of time of wave 5, and this is the amount of time for the first correction after wave 5. And you can see it broke the 2-4 trend line in much quicker time than the 5th wave took to form. So that's the confirmation process that I talk about in chapter 6, which is essential for good wave analysis. So it helps to avoid opinion-based analysis. When most people do wave analysis, it's, this is what I think, and this is what another person thinks, and everybody has all their own opinions. But when you start incorporating rules about confirmation, then it starts to become much more about what the market decides is right than what you decide is right. So if you think this is a 5-wave move and it doesn't break the 2-4 trend line in less time, then your analysis is wrong, and it's not someone else's opinion, it's just a fact. And it's in my opinion, an indisputable fact that it has to do this, otherwise the count's wrong. Now, why does it have to do this? Well, there's a lot of reasons for that, but whenever you're dealing with the beginning of a new trend, this is going down with the larger downtrend. So wave 3, if we have wave 3 ending here and wave 4 is drifting upward, wave 4 is supposed to be a downward moving trend, right? So this A wave would be the very first down move in the direction of a larger downtrend. So it's logically got to move quicker and faster than any counter trend move against the uptrend. Wave 2 and 4 are corrections against an uptrend. Wave A is a correction with the downtrend. So it has to be bigger and faster than the previous declines to prove that it actually is part of a new down phase. So this A wave, you can see, is bigger than all these previous declines, and it also is much more violent, and it breaks a 2-4 trend line in less time than wave 5 took to form. So we have all these different elements being reached. We have violent nature, break of a 2-4 trend line, and a much larger degree, a much larger price movement. The size of a move is extremely important in determining degree. So the fact that it's much, much larger than these other moves guarantees it has to be a bigger degree. So by definition, if this is the beginning of a bigger degree move, this has to be the conclusion of a prior pattern. So for those reasons, this is why the previous impulsive pattern has to end at this high. So let me go forward from that. And if you want to keep your mic unlocked, Dave, we can, sort of chit chat back and forth instead of it being a mono-directional discussion. But after this violent move, you can see that the next rally is slower, about the same size, but it's slower and more subdivided, more time consuming than this drop here. whenever you're dealing with trending action on a chart is always going to be the direction of the largest, fastest movement.
Glen,
So
can I bring you back a little bit? Can I bring you back a little bit? Okay, so you mentioned pattern. Now I look at that and I go, whoa, the only real pattern I can see there is the ABC that I'm used to doing in my own Elliott brain, right? So I see that.
You're talking about this ABC right
here?
Yes,
yeah, correct.
Okay.
Yeah, so with that ABC, you've not labeled it anything on the higher degree after the C wave, okay, the end of the C. So for me, pattern for me is probably an emotional, is a sign for me of what the emotional state of the market is. When I hear the word pattern, is that for you or is that something different?
Oh no, wave patterns are a graphical representation of mass psychology. So the pattern we're looking at is a representation of a certain type of psychology in the market. So, you know, trending patterns have a certain psychology. If you're in an expanding pattern, then the public is going to perpetually doubt that the trend is up until the very end. If you have the first wave the longest, then they believe immediately that the trend is up, so most of the trend is then over. If the third wave is the extension, then they only believe the trend is up right around the time wave 3 comes to an end, which means wave 5 is not going to go much higher than that. So expanding patterns indicate perpetual doubt or belief in the trend until the very end. Expanding patterns indicate there's strong belief very early on and strong participation that the trend is up, but they're all jumping in too early. So the majority of the movement occurs very quickly and it's, you know, it doesn't go much further after that. And then the other important thing to understand about behavior is that the most violent moves in a chart always happen in the direction of the trend. So if you have a violent move up and then an even more violent move down, that violent move down indicates you've finished an old trend and you've now started a new trend. So this drop here is bigger and faster than this rally and all the other rallies and all the other declines. So this has to be the start of a new trend. Okay. Yeah. So there's no doubt about that. After that, you'll notice that this rally is slower and it subdivides more. So this means this is counter trend to this, even though it made a new high. Notice this is more violent than even this move, which reinforces the fact that the trend currently is down. Yep. You with me so far on all that?
Yep.
Okay. So now then the next rule, every pattern has at least under NEoWave, has very specific rules. So number one, when you're dealing with flats, wave A will always be the most violent. When you're dealing with zigzags, wave A will always take the least time. When you're dealing with triangles, expanding or contracting, wave A will always be the most violent. So when you're in a flat pattern, the A wave has to be the most violent. And if it's not, then you're dealing with something else. And if wave C doesn't take more time than wave A, then you aren't in a flat. So the fact that wave C took less time than wave A means we can't call this a flat pattern. It could be a C wave, but it can't be an impulsive C wave, even though it was really violent. Okay.
So is that why you're not?
And then you'll notice that this.
Just for me, the ending of that, you've not labeled it anything. That's giving me my little brain going into confusion. So
well, this right here is this low right there. Okay, so this is a more detailed half yearly chart. This is a 2.5 year high-low chart. So you always want to begin, even though I state otherwise in my book, because I didn't know 30 years ago, this was the only thing I sort of messed up on in my book, is that I assumed you'd want to build wave counts from the bottom up, which is one reason why chapter 3 is so unbelievably complicated. If I'd understood that wave counts should be built from if wave counts are built from the highest time frame and worked downward, then it simplifies everything dramatically and chapter 3 wouldn't have been necessary. But anyway, so on this chart, we're not seeing all the detail that you can see on a 6 monthly chart. And when you see that 6 monthly chart, you can see that the recovery off this low is very slow compared to the previous decline. So this means the trend is still down while this rally is going on. Then you get another violent decline, which is extremely similar to this violent decline. And then all of a sudden you get a move up that's quicker than the move down. So this is where the new trend began, with this violent movement. When you're starting a new trend, it's critical that the new movement is faster and more violent less complicated than the last move that was going in the other direction as part of the other trend. So if you follow this move, you can see this was smaller and this was smaller, and it took a lot of time to get back above this high. Then we had a violent sell-off, and then it was retraced quicker and faster and larger. That was where the new trend began, and that's why I have the C wave finishing in midair over here.
Okay, I get that.
Okay.
Now, just a second, if I may. Matthew, a little while ago, Matthew Furdo, is keen to know if Glen ever uses volume to assist in determine reactive moves versus change in trend.
I don't use that for wave analysis, because wave analysis is sort of an independent logical phenomenon that doesn't really require all this other stuff to confirm. But when I do trading and I'm not using wave analysis, then I do use volume and more traditional stuff. I have all kinds of things that I can show you all after a while if y'all want to go through it. This is the way I set up my charts for trading, which is a whole different kind of world than doing wave analysis. So realize that wave analysis is a separate kind of phenomenon. You're predicting events that you don't know if they're going to happen, and you have no way to be sure they're going to happen. So it requires a very sophisticated way and complex way of looking at things and lots of rules and so forth. When it comes to trading, that's a whole different game. It requires more risk control, and it's just an entirely different game than forecasting. So when I'm using forecasting tools, I only use wave analysis, I only use wave structure, and I don't use anything to back it up, because what I found is typically if you have what I would call a crutch, a technical crutch to do wave analysis, it's going to lead you into decisions that are causing you to have illogical design. And that's probably the primary reason why most orthodox Elliott Wave analysts have been perpetually bearish, calling for the end of the world for 20, 30, 40 years, because they're depending on things outside of actual structure to dictate what's happening, and it's causing them to think things that aren't true. So wave structure, when it's applied in the NEoWave approach and very rigidly, and you don't let all these other influences affect you, it's going to lead you to conclusions that are a little bizarre, sometimes hard to believe, but are much more often to be right, because you're not being distracted with all these things that might allow you to construct an account that fits your belief system instead of creating an account that fits the set of rules that are required for that particular pattern.
So
does that make sense, Dave?
Yeah, it's a purity of thought and focus.
Right.
Okay, so there's a question. I've got a question. I've got another question. You've got a 2.5-year cash data. What does that really mean? Does that mean you only sample the highs and lows within a 2.5 year range, or how does that work?
Yes, here is a monthly chart. So I have the highs and lows of every month plotted in the order they occurred. And then Stefan, my programmer, takes that information and then creates the high and low for every 6 months, and then takes the high and low of every 6 months and takes 5 sets of those to create the high and low of every 2.5 years.
Okay, thank you. That makes sense.
Now, the reason I do this is very important. It's something that most people don't understand, because a lot of people will produce wave counts that look something like this, and they'll try to do wave analysis on a chart like this. You can't do good wave analysis on a chart this complicated, because it allows for way too much personal preference and adjustment and tweaking and manipulation of the information, so that you can design an account to fit what you believe. You want to have the structure of the chart simple enough to avoid personal preferences, and not too complicated to where it allows for any decision to be made. So the ideal range of complexity on a chart is between 13 mono waves and 55, ideally between 21 and 34, but no less than 13 and no more than 55. And if you always manage the complexity of your charts, preferably between 21 and 34, it's going to force you into conclusions that are not necessarily what you like or what's comfortable, but what fits the rules.
Wow, that's significant. You've used the word monowave. You've used the word monowave. You've used the word monowave. If you could like to explain that, what that means.
Okay, monowaves, when you plot charts the way that I do, I'm going to go back to the monthly chart to make it easy. if you have the high and low for every month and you figure out the high came first, the low came second, high came first, low came second, low came first, high came second, you plot them in the exact order they occurred, and you separate each one of them exactly by the same amount of space. It's very important you do not try to space them at the, like if you plotted a month out and the first day was the high and the second day was the low, and then you had the rest of the month empty, that's not going to produce good wave structure. You have to plot every high and low equally spaced apart as if they always happened, ideally, 15 days apart. And when you do that, you start to get really nice wave pattern development. And when you plot it that way, you'll see what I call monowaves. A monowave is a change in direction of this high and low process. And every time it changes direction, it creates a new monowave. So here's one, here's one, here's one. If you get multiple prices in a row and there's no change, well, the whole thing becomes one monowave. So when you're looking at a chart, you don't want less than 13 of these, and you don't want more than about 55. So this chart is way too complicated. This chart, this chart's right in the comfort zone. It's more than 13. It's less than 55. It's probably in the 20s or something, maybe close to 30, but somewhere in that range. So it's in the ideal range for good wave analysis. And if you have a copy of my book and you apply the rules, you're not going to be able to flex this very much, because it's going to force you into very specific conclusions that are not very flexible, which is not going to be the case if you look at a chart like this, where you can decide every low, like I'm going to make this wave A, or I'm going to make that wave A, or this wave two. I mean, you can have tremendous flexibility when you have charts that complicated. When they're like this, there's not a lot of flexibility, so it makes for much better wave analysis. Now, the next thing that's really crucial, a lot of people don't get this either, is as you start from the top and you work your way down, it's absolutely essential that you force the scenario that's produced by your larger time frame onto your smaller time frame. So there's perpetual consistency and logical integration on all time frames. So in this particular chart, if this count is correct, which I'm not so sure about anymore, but if it is, then on my weekly chart, I need to have a D wave here and then explain this and not go back before that, because you don't need to reanalyze history. You just need to figure out what this is, because on this chart, it's hard to see what this is. There's not enough complexity. There's less than 13 monowaves. So it really requires going to the next lower time frame. And this is that same pattern on a weekly chart. And now all of a sudden you have between 13 and 55 monowaves, and you can start piecing together a logical structure that explains this period, which is this pattern right here. So now we have the D wave ending here, the E wave forming here that fits into the bigger picture, but we can analyze it in more detail and then figure out what this is when we go to a daily chart, because there's only like 5 or 6 monowaves here. There's not enough to do good wave analysis on a weekly chart. So then you want to go down to a daily chart and analyze that structure in detail, which I haven't done yet, because these charts you're looking at are done for classes, and I haven't taught any classes in about a month or two, so they're all out of date. But if I had been teaching, they would be up to date. But anyway, so that's the process. You want to start from your largest time frame, make sure you know what the trend is, make sure you know what the count is, and then each time you go to the next lower time frame, you want to start with the last completed structure. So here on this 2.5 year chart, we have this D wave finishing right before the COVID crash. And then the focus of this next chart is just even though I have all this stuff here, my real focus is on what's happened after the D wave. I want to know what is going on. We have 2 choices. And from those 2 choices, I then take that information. I go down to my monthly charts. You can see the D wave is right here. And then I go forward with that analysis. And I may have an alternate scenario here, but you have to always start with your larger time frame and then force that structure on each lower time frame. So you see the D wave here, and then you see the same D wave right here, but more detail. And with that additional detail, we have 2 primary counts. This is the preferred, this is the alternate, but they're both indicating that something important finished here and we're in the last phase of whatever this is. And that structure then is brought down to weekly charts to get a very defined idea of what's happening. And then of course, on daily charts, we're going to work on this. We're not going to work on all of this on a daily chart, because it's going to produce a chart that's way more than 55 monowaves. You have to constantly control complexity to produce good wave analysis. Does that make sense, David? May have lost you there, Dave. I see Ken, but I don't hear anybody.
Yeah, okay. Yeah, I used to be able to press the space bar and it doesn't seem to work in the new version of Zoom, I guess. Um, now, you're managing money. Are you using predominantly um, NEoWave theory, or are you using something else for your management of money? What's the
Well,
what's the
this is
balance?
what happened. Yeah, this is what happened in the year 2000, which was over here. Let me show you the big picture first. So this is the year 2000, right? This is the dot-com boom and the dot-com bust. And as we were going into this period, you may or may not have known me then, I don't remember, but I was warning that we were making a major stock market top into the high in 2000, and that we were going to drop about 50% of the Dow, 60% of the S&P, and about 70% of the NASDAQ. And all those things came to pass.
I did see those calls. I don't.
You did? You said?
Yeah, I did see those calls, but I'm not sure if we were in contact around then.
And I also warned right before, about a month or so before the 9/11, that something real big was coming, really nasty and bad for on an international basis. But I didn't know what the event was. I just knew we were ready for a big drop. But anyway, at this high, I knew we were coming to the end of the most predictable period that I was going to see for a very long time. All this was impulsive trending stuff, much easier to predict, much easier to trade. I knew that the minute that this correction started, and I even predicted it at the time, that we'd be going through a 20 to 30 year bear market. So if we measure this period, now how did I know that? That's because under wave theory, at least under NEoWave, the corrective environments always have to take the same time or more than the impulsive environments. And this was basically 1980 to 2000. So that was 20 years. So I knew, just a little bit under, but basically 20 years. So I knew that we had to go sideways or go into a corrective environment for at least 20 years. Now we started making new highs around year 15, I guess, something like that. But notice that the rally here is still choppy and is not impulsive. This does not follow any impulsive rules. So it's a big corrective rally, despite the fact it's massive. So
if you look at volume,
if
you look at volume, that's a very true statement. Volume's just not confirming, patterns not confirming in what I see as well. Yeah.
So it's not suggesting an impulsive pattern, right?
No, look, I agree.
Correct. Yeah.
Is that what you mean, David?
Exactly.
Right. So that's your volume analysis is reinforcing the visual, obvious corrective nature of the rally. Now, how do I know it's corrective? I knew it was corrective the entire time, because every single time we corrected on a smaller time frame, every correction was identical in time. Every rally was identical in time. That is not the way impulsive patterns develop, at least under NEoWave, which has a lot more rules than orthodox Elliott Wave. I knew the entire time this was all corrective action. So when this was beginning, I knew we were getting ready to go into a 20 to 30 year corrective bear market. I didn't realize the bear market was going to drift upward, but I knew we'd be in corrective environment for 20 to 30 years. And because wave theory isn't great at predicting corrections, at least not nearly as good as predicting impulsive patterns, I knew I was going to be in a nightmare scenario for 20 to 30 years. So that was the beginning incentive for me to start creating a new kind of technology for trading. NEoWave is all about forecasting, but it's not a trading technology. And unfortunately, you know, when I was in my 20s and 30s, I was a neophyte from a trading perspective. And I made the mistake that pretty much everyone else makes, assuming that if you can predict a market, you can make money from it. And it took me about 15 to 20 years to finally realize that prediction and trading are completely different undertakings, require completely different skill set, completely different tools, that trading is actually a lot more complicated than prediction, even though I thought it was the other way around. So I knew that when this correction was beginning, that we were going into an environment that I wouldn't be able to predict very well. So I needed to figure out some way to trade and make money from an environment that I wouldn't be able to predict very well. So that was the foundational impetus for what I now call Neely river theory. And I can just quickly show you some charts on that. Let's see. Here's the advanced version of river theory applied in TradeStation technology. I've spent 20 years paying a computer engineer to implement all this technology into TradeStation. It's over 100,000 lines of code, and it's very complicated and sophisticated, but it produces really cool charts and lots of useful information. It transfers information from chart to chart, time frame to time frame, to keep everything synchronized, and allows you to make trading decisions based on psychology, fundamentals, trend, and relative strength. Do you want me to go into this right now, David? Or do you want me to finish the wave analysis stuff? Dave, your mic's unlocked. I mean, it's still locked.
Yeah.
It's still locked.
There we go. I have to press a special key. Wherever you want to go is fine with me, Glenn. If you want to.
Well, I think we should just finish the wave stuff first, and then we can move on to river stuff.
Yep.
Okay, so again, I knew that it was going to be difficult. Now, when you're dealing with any kind of pattern, whether it's impulsive or corrective, the most predictable waves will be the very first wave and the very last wave of the pattern, and only the waves in the direction of the trend will be fairly to highly predictable. Any move against the trend is going to be very difficult to predict. So this was a very predictable period for me. This was difficult, even though I was bullish and I knew we'd probably go back and exceed this high, but I didn't. The whole time it was going up, I never knew exactly what was going to happen. So I was just generally bullish, but I didn't know exactly what was going on. This decline, I think you were probably following me then, Dave, was the most spectacular earning period of my entire life.
Yeah, same with me. It was a great bear market. Yeah, loved it. Best trading ever.
It was very weird too, to have all my friends going bankrupt, losing their houses, the boats, the cars, and here I was making more money than I've ever made in my life. So it was a very weird environment for me, but this was the most predictable, or the most tradable, let's say. But the first and last technically are the most predictable phases under wave theory. So even though I made a lot of money on this and it worked out extremely well, it's not typical for this to be the most predictable. It's usually going to be the first and the last phase. So for any of you who are following me at all, know that somewhere right around in here, I turned bearish on the S&P when it broke, I think 38.22. I can't remember the exact level, but somewhere in there, turned bearish. And then right after this low, just a month or less than a month after the low, see if I can find it here. Yeah, I can't find it, but it was right after this low, I turned bullish and said that the S&P would go all the way back to the highs. And that's because I could tell that this decline was corrective and that we were starting to show some signs of strength on weekly and monthly charts after this low, which indicated we were not going to go any lower. And then the other thing that I realized, that because of the violent nature of the COVID crash on a half-yearly chart, this would not be properly visible if you looked at daily or weekly charts. It has to be on the proper time frame with the proper amount of complexity so that you're not seeing too much or too little. But I could tell from the violent nature of it on a half-yearly chart and the fact that it stopped short of where it should have reached, which was this area here. How do I know that? Because this drop and this drop, being wave A and wave E of a pattern where the C wave is the biggest, should have been about the same, but it stopped shy of that level. You can see this is where it should have gone approximately. It stopped only about a 61% of that amount and started showing signs of strength. So I realized that this violent decline was going to be wave A of a triangle. And the most likely was an expanding triangle, because the target price still should be somewhere close to this high eventually, at least down to this low, which we still have yet to get to. So with a target price near the 2000 high, the only way to get there is to produce an expanding environment, which initially I thought the expansion would look, hold on one second, I just have to adjust this real quick. I thought the expansion was going to be like this. I'm just going to erase that. And that the B wave would just make a minor new high, and then we make a new low, and then a new high and a new low. But because the B wave has gotten so large, it's producing a phenomenon under NEoWave that I call reverse alternation. So you can see that this rally is slower and more subdivided than this decline, which tells us even though this is bigger, this is a counter trend rally, just like this was a counter trend rally. The trend is down, but the trend, the long-term trend, Dave, if you want to lock your mic for a second, have you ever read the article in the back of my book?
Yeah, I did, but it was a long time ago, Glenn.
Okay.
That was the 100,000 one.
Right.
Yeah.
In the back of my book, I talk about how the structure of the market has been stretching upward over a very, very long period of time. I think I might actually be able to bring up that diagram real quick if you hold on one second, because that's an important part of this big picture. I think the creation of America, and then the free enterprise system, and then the incredible boom in technology that all that eventually created. Now it's moving all around the world. That's what's creating this boom that just keeps getting stronger and stronger. Okay, let me go see if I can get to the last page really quick here.
There's also inflation in general and the debasement of the
Absolutely.
dollar itself. Yeah.
Absolutely. Okay, so here is I'm going to have to zoom in. Hopefully y'all can see when I zoom in, if it will let me here. Let's see. If I zoom in, can you don't see me zooming in there, do you? Let me try this.
Yeah, you're getting good. That's good. Oh, you had it there before. Last
So
time.
is the chart getting bigger?
It's getting bigger now. Yeah, yeah. And
the chart is.
Yeah, it got bigger. The text is certainly bigger.
Yeah, the text is getting bigger, but I don't think.
But there was one point where the chart was bigger, or it looked bigger.
Let me see if I can. Let me see if I can double click on it and get it to just open up that chart.
Or
I don't think I can.
Can you do a screen snap? Can you do like
Yeah, let me try that. Hold on a second. I'll take a picture and then I'll maybe import it into the system. So give me 1 second here. Not sure what that is. Okay, hold on. I'm gonna have to pull it in from my Mac side because it took a picture on my Mac side, but I'm gonna zoom in on this chart because it's very important for you to understand what's been going on for so long and why many technical analysis forms don't quite understand what's going on, and why they, especially the orthodox Elliott Wave crowd, why they keep being bearish in an environment where it's really not the appropriate thing to believe. Hold on a second, let me close this. I think I can just drag this over and we can look at it. So let's see what happens. Okay, there you go. Now I think I can zoom in. So how's that?
Yeah, better.
Okay, so we're getting the same phenomenon on a shorter term basis that we're getting on the longer term basis. So here I had to backwardsly project where the start of the United States occurred and added in that data to create a standard 5-wave move. Then we went through a correction, and then you notice this rally was more mediocre than what we see here. And there's a lot of hesitation in here, which is not the behavior of a third wave, which is why this whole thing had to be an X wave followed by a contracting triangle. And this is what R. Elliott thought was going on, but nobody else seems to want to believe that except for me and him. And the X wave tops almost exactly 61% above the length of wave 1 right here. Then we go through this correction, and then we start moving on. Notice this advance is faster and larger than every other advance going back in time. That's because this 2 wave, which took about 100 years, is drifting upward, being caused by the technological revolution, possibly the creation of the Federal Reserve and inflationary currencies and all that stuff, but most likely because technological innovation was creating improved living standards around the world. So you can see this is moving quicker and faster, then this moves even quicker and faster. And so every time we're advancing, we're going up faster and faster. And this was the 1966. This is the 87 crash. This is about, I think it's 1995. And this would be the high in 2000 and so forth. So we're somewhere in this area right now. And that's why the market keeps drifting upward, because it's mimicking the power of these other patterns. And there's so much future force that all the corrections are being stretched upward. And that's how I get this upward stretching, because it's being caused by the incredible long-term power of this big trend. And we're now accelerating above the standard 0, 2, and 1 channel. And we're probably going to double or triple the width of this original channel. So that's where all this comes from. And that's why this pattern is drifting upward even stronger than I think any pattern I've ever seen. So that's the big picture. Let me move this back up off the bottom.
So it's a corrective super uptrend.
It's a correction that's trying to go down, but the future uptrend is so powerful that it's stretching the pattern upward. Now, how do I know that? because the downtrends are faster. It's telling us it's in a downtrend. The uptrends are all slower and they're all corrective and there's no alternation or anything. So we know this is not impulsive, but it's drifting up dramatically. So that's how I know that this is an upward drifting correction, and that when this is over, we're going to start the most powerful bull market in world history. That's probably going to begin sometime in the next 5 years, give or take. So for those of you who are around, you'll probably be able to make more money easier than you ever have in your entire life, just by being long and not doing anything.
I love those
buying
times.
Bitcoin 5 years. Say it again?
Buying Bitcoin 10 years ago. Yeah, exactly. Just a question.
Exactly.
If you were to choose which you prefer to analyze, the Dow or the S&P, what is it?
Definitely the S&P, because it's a broader index. The NASDAQ is too specialized. The Dow is too limited, and it's the largest 30 companies in America, basically. You want to have a broader view. You might even do the Wilshire 5000. That would be even better. But the S&P is a good mixture of a lot of different technologies and different companies. And so it's big enough to be fairly accurate representation of America.
Right, thank you. Would you feel like going off to where you're actually, how you're actually trading now, and
Okay.
rather than forecasting?
Okay, so as I mentioned earlier, I had to make this transition about 20 years ago into figuring out a new way to deal with markets, because I knew that wave theory would not be very easy. And I can tell you that this 10-year period was the most horrendous wave analysis period of my entire 40-year career. I mean, I barely knew what was happening for 10 years. So I'm so glad it's over. I can't tell you. Now we're in the final phase, so predictability has increased, but just lately it's getting difficult to figure out when this B wave is going to finish, just like it's difficult to figure out when any B wave is going to finish. But the minute it's over, we're going to know, and then the predictability is going to dramatically increase, and it's probably going to be very similar to what we had during this period here. Okay, so let me go ahead and close these charts. I guess it's not necessary to close them, but I'll close them anyway. If we want to open them up later, we can get back to that. So as I started studying markets from a completely different perspective, that with the idea of trying to trade instead of just being able to predict, because as I got better and better at prediction, I would say for the first 10, 15, 20 years, my ability to predict markets was progressing almost logarithmically, but my trading capabilities were probably only progressing arithmetically. So there was starting to be this vast divergence between my ability to predict, my ability to make money from trading. And there would be, great periods of trading and then horrible periods of trading. And after a certain point, I just started thinking, what in the hell is going on? I mean, this is just doesn't make any sense to me. Like, what am I missing? And that's when I began to realize that the problem is that trading is a completely different phenomenon, a completely different skill from forecasting, and that your trading will be better the more you remove from the forecasting aspect of it, and the more you have techniques that are not centered around what you believe, but centered around objective kinds of technology that tell you when to get in, when to get out, what to do, but not based on your opinion or your belief about what the future holds. So that was the initial sort of foundation and birth foundation of river theory. And over time, I started to recognize that the greatest failure for most trading systems is that they focus on one aspect of the market. There's really three ways of looking at markets, and there's only three. You can either be a top and bottom picker, which means you're going to be using overbought, oversold kind of indicators. Or you're a trend follower, which generally means you're using moving averages. Or you're a fundamental trader, which is going to be what I call bargain hunting. So you're getting in when most people are getting out, at psychological kinds of extremes. So there's fundamental, there's technical. Fundamentals are going to be based on things like book value and PE ratios and volume flow and relative strength, things like that. The trend analysis will be based on moving averages, momentum indicators, MACD, things like that. And the top and bottom picking stuff is all emotion and psychological stuff. So I use river theory for the psychological element, because river theory helps me see all the different kinds of traders, the top and bottom pickers, the bargain hunters, the trend followers, and I can figure out who's doing what, when, and where, and decide when the majority are getting out, even if the trend is up, or when the majority are going long when the trend is down. I use the weekly time, that's on the daily charts. On the weekly time frame, I use trend analysis to catch sort of intermediate term trends. And on the monthly chart, I use all the fundamental stuff, things like volume flow for detecting accumulation and distribution, use relative strength to indicate which markets are stronger or weaker. So you're getting in the strongest or weakest sectors that are likely to produce the best results. And it's been this constant evolution. It's been a 20-year evolution to sort of piece all this together. It's similar to what I did with wave theory, but that only took about 5 or 6 years. This has taken about 20 years to get to where I think it's almost perfected. But to give you sort of a broad view, river theory connects the behavior of markets to the behavior of a river. So if you were looking at a river and maybe simultaneously looking at a market chart, you could start to recognize there's periods of turbulence and slow, choppy action, which is going to occur near the perimeter of the river. Then there's periods of more trendy behavior, which occurs as you move away from the edge of, the turbulent area of the river, and you pass what I call the event horizon. It's that point around 25%. So let me use an actual example. A second here. I'll pull up just the QQQ. I'm hoping the chart looks good enough to talk about. Okay, so I'm gonna have to go to my other charts. Hold on a second. Okay, so here is Microsoft, and you can see, let's look at the daily chart. So you can see here how the market is sort of chopping around the bottom of the river here. And now just recently it's broken out and starting to accelerate as it moves through the center of the river. And when it reaches the other side, it's going to start getting more turbulent again and slowing down. So river theory provides a very, you could say, scientific way of determining how to draw channels, what kind of channels apply to each environment. So in this particular case, you notice there's a purple color. That's purple for price, which is a persistent or trending kind of environment. So river theory is indicating we're in a trending environment where the market's going to have an orderly kind of sine wave progression, and that allows you to trade it in a specific kind of way. You'll be looking to exit positions or protect positions up here, looking to go long around here. When you're in a time environment that's T for tan for time, that's a more treacherous and can be hyper trendy, or it can be treacherous, where you have a nice orderly, a nice powerful kind of move, and all of a sudden, wham, it goes through a violent correction. I'm going to pull up QQQ, and you can see this during the COVID crash. So I'm going to pull up something else. Hold on, because that doesn't look quite right. I think ARKW looks good enough for this. These are positions that we actually have in our customer service trading account. Okay, so here you can see.
Glen, ARKW is a fund itself, isn't it?
It's a new generation internet, like high-speed internet stuff.
Oh, okay. I thought it was there was some sort of fund.
World index. So I'm going to get rid of this stuff at the bottom just so y'all can see the chart a little bit better. So what river theory does is it helps you understand the psychology. So it's like, it's similar to wave theory, but it gives you very specific trading approach to the market. Instead of trying to predict what the structure is and how you should trade it, it gives you very specific entry and exit guidelines based on who's in charge of the trend at any particular point in time. I'm trying to get this chart to expand. Hold on a second here. Okay. So let me go full screen on this. Okay, so you can see on this chart, the tannish brownish color is for time. Time is the emotional public group and the top and bottom picking professional group. So you have the public, which trades on emotions, and they're just jumping in because all their friends are jumping in, and the fear of missing out. So they just, hear about something doing really well, so they just buy because it's doing well, not because they understand markets. And the opposite side of that are the top and bottom pickers who are taking advantage of the neophyte public who's buying into strength where they're buying into weakness. So here you can see this yellow bar here. It's like a violent bar. These yellow bars are violent bars in relation to the kind of range that was previously established. You can see this bar is a lot bigger than the average bar for a while, and these are also. And you can see here how this line continued to be brown, which means time was still in charge during the very trendy phase, during the treacherous violent sell-off, then sort of during casual trendy phase, and then another violent sell-off, but it stayed in control the entire time. But during these violent periods is when river theory would have told you to go long, because it would have given a buy signal as you broke or reached this low. Let's see, 1419. It didn't quite break it, but it got right down within a few ticks of this low, and you can see how violent it was. So you go through trendy periods and then violent, and then this has been an unbelievably trendy period. And now we're starting a correction, which means we're now susceptible to much larger sell-offs at this time, because we're in this treacherous environment. While you're trending, everything's fine. The minute you start breaking lows, it becomes very dangerous. So we're in that kind of environment right now for this particular market. Let me close this window back to the way it was. Okay, so that's on a monthly time frame. On a daily time frame, you can see here where it's showing we're in a more orderly kind of trend. So we're in a price or persistent trending environment, which means it'll be more sine wavy. And when you're in this kind of environment, you want to buy test of the old high. So it's going to move up and come down and test this old high, and then it moves up and it comes down. So old highs become new lows in a price or trendy environment. When you're in a time environment, you get these panics. So this is another time environment here. You see where this purple thing, which represents price, how that turned negative. So the trend traders here were going short as this low is broken in an environment where they're not in charge of the trend. The top and bottom pickers here, what I call the time traders, the top and bottom pickers are in charge. So they're looking to buy as other people are panicking out. So you can see a panic bar decline, and you can see price turning negative below this low. So this was the ultimate chance to go long this market, was right at this point on that particular week, and then waiting for the possibility of a recovery in the market over a period of time. That's on a weekly chart. So let me see, where was I before? So the general concept of river theory is that you have the perimeter of the river is sort of the fundamental determinant of trend. You have either a trend that's a river that's going up or it's going down. This is all determined by money flow. You have to have demand in a market to produce trend. So if the money is flowing in, the market's going to go up. If the money's flowing out, the market's going to come down. So I've created a variation of on-balance volume here to show me periods of accumulation or distribution. So that's sort of a fundamental perspective on volume. And then I have an exponential moving average, which I've designed as a derivative of MACD. It's what I call the extreme MACD. So it helps to tell me almost the moment that the trend might be turning around. And if you have demand and evidence of the river starting to move up or moving down, then you have the chance to potentially start trading on the long side. So you can see here where they both began to agree, where volume was still negative, but when volume turned positive and the extreme trend change based on extreme MACD, again, that's my own indicator, so you're not going to be able to find it anywhere, but shows that we're now back in sync, where the river is starting to flow up and the volume is backing up that flow. So now we can look for long trades on all time frames if the setups are proper. So that's the setup you first need on a monthly time frame. And then after you pass the perimeter of the river and you start to move in the more trendy period, then you're going to have a situation where the market starts to break out on a monthly basis. And this shows when you started trending new 52-week highs. So you're moving out of the consolidation on a monthly time frame and you're starting to break out. So this is actually a 52-week high kind of breakout thing. And it's showing me as long as the market is broken out over so many months, it's made a new high within a certain period of time, that it's going to remain a positive perspective. So as long as this is positive, then you can use moving averages to buy during downswings. So now you're in the trendier part of the river, so it makes it safer to buy weekly time frames, because the monthly is giving you like a tailwind in an airplane or a strong river current behind your boat. It's keeping the market from dropping too much. So when you get a sell-off, you can buy it and catch the next advance. So all these drops into the middle of the channel would have been points to go long. Now, once the monthly and the weekly are all in sync, then you're basically in the dead center of the river, the fastest moving part. And what you want to have is very strong relative strength in the market to prove that you're in the middle of the river. And I've designed my own relative strength indicator. I'm not going to tell you how I do it, but it lets you know when this particular market on a yearly basis is stronger than 80% of all the markets in the world. And that allows you to trade daily timeframes and more directional kind of trading. You don't want to trade directional trades unless you're in the very fastest part of the river, so that there's very little risk of the market going against you. So if you don't have the relative strength strong enough, you want to stay away from the shortest time frame and just work with weekly as long as it's positive. And if that's not positive, then you have to trade monthly time frames. So it's adjusting the time frame you're trading based on how strong the flow of the monthly river is. The weaker it is, the more you're going to have to just buy stock and be patient. As it starts to move into the trendier part, then you can start trading intermediate and weekly time frames. And as it starts to really accelerate relative strength wise in relation to other markets, then you can start trading much riskier, long calls on daily time frames with short durations, things like that. So the riskiest trades would be implemented on daily time frames. More, moderate risk and lowest risk would be the longest time frame. And so this, in a nutshell, is the evolution of river theory over a period of time. I have two versions of it, which won't make a lot of difference to y'all, but I have two versions: the simplistic foundational concepts, and then I have the more advanced one where river theory is incorporated on all time frames, not just on the daily time frame. So it allows for a little more precise and finessed entries than you would get from general, trend analysis and volume analysis and stuff like that. So I said a lot, David. Are you still there?
I'm still there. That's awesome. Do you have some bonds? Can you show us the bonds? I noticed you got TLT up on your list there. So what do you?
Yeah. Now to explain why I have this, because I manage a fund, I manage my own money. I have a customer trade. I also have a friend who gave me $1 million to manage for him. So I have to keep track of the general main categories. So I have the Dow, which is very specialized, the NASDAQ, which is specialized. TLT is notes, this is gold, this is euro currency, this is oil, and this is crypto, Bitcoin. So I just want to see if any market is moving more than a certain amount. If none of these are moving more than 1.5%, then I'm only going to check on the performance of my positions about once or twice a day. Because if the markets aren't moving much, then my positions can't be moving much. If my positions start moving, then I'm going to start getting much more concerned about if they're doing well or not doing well. And this is the sort of the big separation between trading and forecasting. If you're using what I call a forecasting paradigm, that's when you're constantly predicting what the trend's going to be, deciding if you want to get in, deciding where you're going to get in, or predicting where you're going to get in, predicting where you're going to get out. And every time you make a prediction, your odds of being right are probably 50%. So if you do, 50% of the time you're right about the trend, and 50% you're right about where you're going to get in, and 50% of the time you're right about where you're going to get out, you end up being right only about 12% of the time. So that's the reason the forecasting paradigm doesn't work. You have to have something that eliminates most of the forecasting, so you're left with a very methodical, objective, scientific way of trading that gets rid of all the emotions and all the expectations and just lets the market dictate to you how you should manage it. As an example, let's say that you were investing in a new technology company in a category that never existed before. The only way you could invest in that is you'd have to predict what the market's going to be, what the demand's going to be, what the price is going to be, the margins are going to be. All these different things have to be anticipated. So you create this, a business plan with all these forecasts and stuff. But once you start the business and the business starts losing money every single day, you're not going to keep going back to your business plan and say, well, it says we're supposed to make money, so I'm just going to keep throwing money at the company while I'm losing and just keep doing it over and over and hoping and praying eventually that my original business plan is going to be right. That's not the way you run a business. So most people trade that way though. So once you're in a position, it's crucial that you completely forget about what you believe, where you think it's going to go, what you think is going to happen next, and you specifically manage that position strictly on performance, not beliefs or forecasts. And if you do that, then you're giving the position time to increase in value, or you're giving the position time to go against you enough to where you start to get out. So for me, if I'm trading stocks, it goes against me 10%, I'm going to liquidate a third. Goes against me 12.5%, I'm going to liquidate half of what I have left. Goes against me 15%, I completely exit. If I'm trading options, goes against me 20% long, a naked long option, or even a spread, goes against me 20%, I'm going to liquidate a third, 25, half of what's left, and 30% get rid of all of it. So you have a backstop on the downside where you're giving all these positions time for the market to perform or not perform. Because remember, when you get into a position, you know at that point why you got in and what you're expecting. But then you just have to be patient and wait for the market to actually produce the results you were hoping it was going to produce. And that only comes from waiting and actual evidence, not from what you believe. So once you're in, you just need to give it time, and it takes longer to make 3 times your money than it takes to lose 1/3 your money. But you need to have that 3-to-1 profit to loss ratio always in effect, so that when you take losses, they're about 1/3 of what you exit a position at a profit. So when I get out at 20% on one side, I'm not going to take profit on the other until it's up about 60%. And you have to give it more time to do that. But then over time, if you allow this time and you have a good entry strategy, then over time, mathematically, you should end up making money on your trades. So the only thing you need to work on is the initial entry. But then after that, it should all be performance based and not opinion based, not forecasting based.
Yeah. Thanks, Glenn. That's really cool. I asked about the bonds, but I've got another question before I want you to go.
This is the bonds right here.
Oh, this is the bonds? Oh, BNDs. Okay. Yeah, because
total bond market.
Yeah. And I was asking about the your NEoWave analysis of the bonds, or the notes, whatever you analyze. I think you do the notes more than bonds. Let me give you a
trading perspective on it first.
Yep.
Let me see. I think we have a position on this, if I'm right.
Because it's been such a great bear market. One of the best bear markets I've been trading for a long time, actually.
Okay, so you can see here there was a choppiness back and forth between positive volume, negative volume flow. So it was a little choppy as it was topping out, but you can see that my extreme MACD started giving warning signs of a sell signal. So the month after the high, there was the first chance to potentially go short where they were in agreement with each other. So this indicates on a monthly basis, you're potentially topping out for a long time, right? And there was some, bouncing around with the volume that would have kept you out if you didn't get in earlier. And then you had another chance here before it really started to sell off, where it's been negative consistently. So we have money coming out of the market, which means it has to go down, because money coming out always means lack of demand and prices will drop. And then we also have exponential moving average evidence that we're declining. So we had 2 reasons to go short, where we're in that monthly river and we're at the edge of it starting right about here. And it's starting to move quicker and quicker. And there's a certain point, let me connect these charts here. There's a certain point where the weekly will start to agree with the monthly, which means you're no longer in the perimeter of the monthly river. You're starting to move into the acceleration or the trendy part of the river, right? So you can see here, I'm going to go 1 month at a time. You see the weekly was still in an uptrend. There was no, coordination between the two. So the only trading you could do, which is what we did, we went naked long puts for September. So we went, about 6 months out when we first got in, and that was done somewhere in this area. I don't remember exactly. So we're in those puts, and the market's, now moving down. Now you notice right after this happened on a monthly basis, let me go to the weekly chart. You can see the weekly trend analysis. This is a very complicated moving average that I call my mode index, but you could use more generic trend analysis. Let me just pull up something simple here. What is the moving average in TradeStation? I thought it was E. Maybe it's M. There, 2 lines. Okay, let's see what this does. That doesn't look very good. But right where they cross, I think would be where it turned down. So it's very close to where this one turned down. So my mode index indicates that now we have a downtrend on a weekly basis that's now in sync with the monthly. So we're now moving out of the perimeter of this monthly river. We're starting to move into the trendy part of the river. It's starting to move faster. So you could instantly go short as long as the weekly trend agrees with the monthly downtrend. Okay. So you could have gone short in this area. Then it started to accelerate down. Now, it didn't really fully agree until there was no more indication that the market wasn't trending up on a yearly time frame. So right here would have been the best place to get in, where it's no longer fighting. The two trends aren't fighting each other. And then once that happens, you can see right at that, very close to that moment on the daily chart, right at the time we switch over from the weekly not being in agreement to no conflict, where this is just neutral and this is negative, you can see that we now start to show relative strength of this particular market on a monthly basis is now turning negative. So now we can actually go short on a daily time frame in a trending kind of way. And you can see that was the very beginning of the really trendy period on a daily basis. So that gives you a very good visual of how the river phenomenon works in a real market, how you start off slow, you start moving a little quicker. And right at the time, most people are afraid to actually take a position, like right here after it's dropped quite dramatically. Under river theory, it's indicating this is actually a much safer time to enter because you're not dealing with all the choppy, the fighting that's occurring for the longs and the short and trying to catch the top or catch the bottom and determine the bigger trend. Once the monthly and the weekly start to agree, you get much more trendy behavior and it becomes safer, not more dangerous, even though most people would be very uncomfortable shorting in this area. And then it becomes even safer on daily charts when the relative strength starts to turn negative along with the monthly and the weekly trends. So that's what makes river theory unique. It makes it a logical construction in your mind. So you know why you're doing what you're doing, you know how to enter, you know why you're entering, you know where to enter. It can be all done unemotionally, and then you can manage all your profits and losses objectively and not constantly be in what I call the forecasting paradigm, which is, you know, that daily grind, that exhausting daily grind of constantly figuring out what's going to happen next. And should I get in? Should I get out? Should I stay in? All these questions that just fill the mind with a bunch of nonsense and have nothing to do with performance. Because the only thing that really matters, is it performing or is it not performing? If it's performing, you just let it perform. If it's not performing, you're going to want to get out.
That's beautiful. That really is. That is beautiful. What you just said. Love that.
You can see that. Excuse me, I just choked on my tea. You can see that river theory has progressed quite a bit since I did my seminar with you 15 years ago.
Yeah, definitely. You really got it down. I also like the way, I didn't know that you could do this on the triple screen, where you could actually have your monthly point and your weekly point and your daily point moving along together. That's just, so I learned something about TradeStation. I haven't seen that in any of the softwares that I'm using.
Yeah, this is only in TradeStation 10 that you can actually coordinate all time frames. So when you click, it shows you the same place on all charts at the same time, which is really nice for studying history and stuff.
Yeah, beautiful. And that's great on trading. Okay, so just before we go across the maybe Elliott Wave on bonds, does your Jimmy's asking, does your software auto calculate the wave in river trading domain? So in other words, are you getting a wave count generated on the TradeStation software?
Oh, no. River theory is devoid of forecasting. That's what makes it a very unique kind of trading technology. It's not attempting to forecast what's going to happen. It's attempting to predict, to pinpoint the precise best time to enter based on all the conditions of the river concept. So, you know, again, if you think in the terms of a river, you know that it's going to be very dangerous to enter near the turbulence. You want to be in the middle of a strong river, not a little weak stream or in a lake. If you're in a lake environment, you're not going anywhere, right? You want to be in something that's moving, which has to do with relative strength. You want to be in a strong or a weak market that's way stronger or way weaker. So you know you're dealing with a strong river first. And then once you're in that strong river, you know, identified by relative strength, then you only want to be in those positions that are moving into the trendy part. You don't want to deal with all the turbulence. If you're going to get in early, you can only trade super safe, long-term buy stock or buy short stock or buy long-term puts or long-term calls. You want to deal with something very low risk, deep in the money if you're going to buy options, because you're dealing with monthly trends and they're going to be moving up and down a lot. Once you start getting a trend that is in sync with the weekly, then you can start getting a little more risky because you're moving in the quicker part of the river and movement against you is going to be much less. You know, if you're, let's say you're in a river and you're swimming, who wants to swim upstream? You're not going to get anywhere, but that's how most people trade. They're constantly trying to pick the bottom of something like this because they think there's more potential, but you get the easiest money, the fastest at the lowest risk, actually with trading with the trend, but entering on a reaction to that trend. Like right here is an example. Let me zoom in on this daily chart. I'm going to get rid of this bottom thing here. There was multiple chances, I think, to enter here. Let me just double check. Yeah, here was one. So you can't quite tell, but oh, sorry, my watch is talking to me. Right here, you see that number 3 in green? That means time was positive right there, and price would have been positive also right there, which means that the trend traders would have been going long in this area. The time traders or the emotional traders would have been going long in here. While this is a distribution bargain hunting or distribution kind of environment. So it's bargain hunting for the short side. So when the two traders that are not the fundamental bargain hunters are actually going long, they would have been going long right into this area. That's the ultimate chance to go short. So let me coordinate the charts again. So right at this moment, the weekly trend was already down. The monthly trend has already been established. The daily trend is showing it's in a downtrend, but before all this happened, you would have had your price traders and your time traders buying in. And when you're trying to get into a downtrend, you want to get in while certain groups of people are going long or they're getting out. They're getting stopped out or they're going long because you want to get in while they're getting out so that you're getting in at the best possible price. Because you know the trend is down. It's established by this blue line here and this down blue arrow. So you know the trend is down, but you only want to get in when the other groups of traders are doing the exact wrong thing at the exact wrong time. They're trying to pick a bottom in here, which is this area here. And they're doing the wrong thing because the trend of the river is down and they're going to get hurt probably pretty bad by doing this. So this would have been the point where you could have gone short right in this area and technically would have been right at that, right here, 1 bar before the high, because there would have been 2 bars up and 1 bar down. So right before the high, and I think into this high where price would have turned positive, you would have the ultimate chance to go short. You're in sync with the weekly, you're in sync with the monthly, you're in sync with the daily trend. And I think we were also in sync with the relative strength. Let me throw that back in. Sorry, it takes a minute to redraw. There's a lot of calculations required for this.
Just while you're doing that, Max has said, if there's a river theory, how about ocean theory? There was an ocean theory by the guy who created Delta theory, Jim Sloman. He had a book called Ocean Theory, like the.
No, I never heard of that.
You hadn't heard of that? Yeah, you know, it's definitely ocean theory. I remember I had a lot to do with Van Tharp over the years, and he was a good mate of Jim Sloman, so I got into that. So we got an ocean theory, a wave theory.
There's no trend. So it makes the concept a little difficult. An ocean would be more like a lake environment. You know, if you have a lake environment, nothing happens. But if all of a sudden the right side of the lake dam breaks, then all of a sudden it starts moving. And the minute the water starts moving, you start creating fluid dynamics, which creates turbulence at the perimeter and friction along the edge of the river and trendiness in the middle. Same thing happens with markets. When money starts to flow up or down, it's going to start creating a directional nature to the trend. And once it starts trending, it's going to start creating these fluid dynamics on the chart, as long as you understand how to read it and how to channel it and so forth. So anyway, here is the short trade. And you can see that the relative strength was also agreeing that this was an environment where it was safe to short on a daily time frame. So you could have gone directionally short during this period. And the only other time you could have done it would have been right, not there. This time is turning positive, but price has yet to turn positive. So there's no current indicated entry, but we might get one if it breaks the high over here sometime real soon. So like in the next day or two, if it breaks this high, we'll actually have a short-term sell signal in this particular market on, for the bonds.
Thank you. Thank you.
Okay.
Would you like to do Elliott on the bonds, or shall we move on to other questions?
Yeah, it's not, the wave structure is not very good there.
Yeah.
Wave structure is sort of a mess on most of these times. I can give general ballpark stuff, but I can't get that specific.
That's okay. Just a quick general ballpark.
Okay.
I felt like it's bottoming myself for a little while. But
I'm going to open up all 4 charts here. Do any of y'all trade cryptocurrencies?
Yeah, I do a lot on cryptos. I have a very,
How have you
very
done on
keen
that?
following it. Great. It's actually the best emotional market I've ever seen, and it really it just kind of has good seasonal cycles. It's got a lot of good emotion, and it does good projections. Really fantastic.
Very trendy.
It's a real it's unblemished by government intervention.
I have an acquaintance, I can't call him a friend, but I have an acquaintance that I met a few years ago who, pretty much didn't know anything about Bitcoin, didn't know anything about cryptos, but a friend of his apparently did and told him to buy some. And this was 5 to 7 years ago. He spent $25,000 on Bitcoin 5 to 7 years ago. And when I met him, which is maybe 3 or 4 years ago, I don't remember exactly, he was at this restaurant and he was looking at his phone and all these numbers were flashing by. And I looked at it, I was like, what is that? He says, oh my God, I bought Bitcoin a few years ago. I spent 25,000 and now it's worth $50 million. And I went, oh my God. And that was when Bitcoin was at $3,000. Okay.
Yeah.
And so I wrote to him just recently and I said, I hope you didn't sell your Bitcoin. And he wrote to me an email. He said, dude, that was that was the whole title of the email. And he sent me a picture of his wallet worth $5 billion.
Wow.
That's got to be the most incredible Bitcoin story of all time.
Yeah, well, I've got one. Guy bought 10,000. Sky and I bought 10,000 Bitcoin for 5,000 Australian dollars. It's now worth 800 million.
Did he keep it?
But he had it entrusted by another chap who he believed in, and it's been taken.
No!
It's been taken. So, yeah.
And what happened?
It's a progressing story.
He stole it?
He stole it. This other guy has something like 85,000 Bitcoin that he's pinched off other people.
Oh my God.
85, unbelievable.
Well, I knew about Bitcoin when it was $10 or something like that, and I was going to spend $10,000 on it. But let me tell you, it was so complicated
That's
7 years ago to buy.
That's exactly those exchanges. There was a list of exchanges on a screen, and you're dealing with futures and shares. But before that was just probably 2010, 11. I couldn't work out what to do with it. And
it was so complicated that I didn't get around to buying it. Stupidest mistake of my entire life.
Exactly.
Because I knew about it a long time ago. And I still know that Bitcoin and cryptos are going to change the entire world. It's going to destroy the banking system, bring down governments all over the world. It's going to be the most revolutionary thing ever to happen to the history of man, in my opinion. And that's what's going to justify the final explosive advance to maybe Dow 200,000 or more. That's what's going to fuel it. Free money, no tax, no direct taxation anymore. Income tax will be gone. It'll be, like the best environment of all time.
Yeah.
Anyway.
Amazing. Okay, so back to the notes.
Now, this is a very difficult situation because the behavior off the high does not look right. So I have two scenarios for this. Let me see if I can change the color of this. need to undo that. Hold on. I'm not sure how I change this, but I'm not going to just realize that this A wave would be a secondary choice. But the further down we go, the more I'm going to have to move the A wave to this lower high. So it's one of these 2 points. If it's the higher point, the B wave is not likely to go much below this low. The further we drop, the more we're going to be forced to move the A wave to the lower high, or maybe even complete the structure here, but I don't know exactly what that structure is. It's a very bizarre count. This is the longest term history I have on interest rates. This is a 10-year cash yield plotted upside down to look like T-notes. You can see all this is very, choppy corrective action. And all of a sudden we get this hyper unbelievable rally in T-notes and the 10-year cash yield upside down. That had to be the start of a new trend. And based on the violentness of it, it probably didn't start here, and it can't start there, and it can't start here. It can only start here or here. And this is the best choice based on the unbelievable violent nature of the move out of the blue. Now, realize that there's a chance that this is all massively distorted by human decisions, with the Federal Reserve deciding and the governments of the world deciding just to throw money at the markets indiscriminately, and printing money and everything else. So it's possible that this is warped wave structure, and that what we're seeing is just not going to be reliable. But this is the big picture for sure if it's reliable. We have an A wave at the high, and we're currently in a B wave decline. I don't know what the B wave is going to look like. I don't know how long it's going to take, but we're in a B wave decline, no doubt about it. When you take this down to the next lower degree, that's when you get to this chart here. And because of the way that it's moving, I can't be sure if wave A finishes here or here. It's very hard to decide. This is a violent movement, but it's retraced more than 61%, and it's even retraced about 80, 85% over here. So it can't be the start of a new trend. So it could only be wave A, or did you say something?
No, I didn't, but I probably was clicking my thing.
Okay.
I do have a 10-year bond constant maturity yield data back pre-1800 if you want to have a look at it.
You want to change screens, and you can share your screen?
Yeah. Let's do this. Share screen.
By the way, regarding cryptocurrencies, I think I have a crypto expert who I talked to. I think the next great crypto is going to be Tron, which is just recently, I bought it at 5 cents. It's now about 15 cents. And I think it could go to about $5 over the next year or two. So that's based on wave structure.
Yeah.
Okay, so this chart is plotted. This is the correct direction.
Yeah, this is yield based.
So these are interest rates. Okay, so it's really going the opposite direction. Can you invert this chart or not?
Unless I stand on my head. Yeah, but that's no. This is straight off globalfinancialdata.com.
Oh, okay. So it's not your own chart.
It's not my own chart.
Okay. This looks very fishy coming down from 20%, but I'll just have to trust it.
Remember the late 70s with who was the Federal Reserve guy?
You need to give me mouse control.
Yeah, I can do that.
Request.
Okay, I can do that. Proof.
I just requested it.
Yeah, there you go.
Okay. So wow, the chart actually moves.
Yeah, you can blow it up.
It's copied and pasted, huh?
Yeah. This is off my forecast webinar. So
I'm going to have to annotate this to.
Is that better?
So y'all can know what I'm pointing out and what I'm doing here. So let's see, mouse. Okay, can you see the mouse moving, or?
Yeah, I can.
You can see this arrow?
Yeah, and a straight PowerPoint. There you go.
But do you see the arrow moving?
I can see
it moving, or only
I can see Glen Neely blue arrow to the right.
But you don't see the white arrow moving around.
No. I can see it moving. Yeah, I can see it moving. Yeah, you're now in the 1825 area.
Okay. So where am I right now?
You're 1850.
Okay, good. So you can see the mouse.
Yeah.
Okay, so let me go ahead and get rid of this. I'm not sure if okay there. Okay, so this is really strange.
I think it's
I don't know
possible
what the,
because remember the US had a lot of funding problems back in around
that's not what I mean. I'm not saying whether it's
1776.
possible. I'm not saying,
Yeah.
I'm talking about structural behavior. It's very strange.
Okay.
So it makes it extremely difficult to understand what's going on there and how it relates to everything else. When you're looking at a chart like this, the primary goal is you need to find where is the biggest, fastest move on the entire chart. And that, of course, would be this decline. But then after that, nothing happens that makes any sense to me. Let's see. I'm going to see if I can draw on this chart and see if I can come up with anything that makes any kind of sense. Oh, man, this is a real mess.
I'm glad I asked the question. It's good to see.
Yeah, it's very, don't move your mouse, because when you're moving your mouse, then I
Oh,
can't do anything.
you take over. Okay.
I mean, that just looks too extreme. This is a log scale, so that makes it a lot easier to work with. Hold on a second. I got to just make some measurements on my chart here. Okay, so wave C would be a little bit bigger. That wave E would be, I mean, this is some really strange action. Oh gosh. I mean, my first inclination, even though I can't prove it yet, is that maybe, and this is a big maybe this is wave A down here. And maybe this is wave B. Let's see. I don't like having an expanding triangle expand this much. That's usually a problem. And I don't like the fact that there's not, there's just a lot of extreme behavior here, which is very strange looking. The C wave is only a little bit longer than wave A, so that's good. The overall structure of wave A sort of looks impulsive, but the reaction afterward is indicating that it wasn't. So that allows me to assume that this is corrective, even though it has somewhat of an impulsive look to it. There's no doubt all this is corrective, all this is corrective. This is probably corrective, even though I can't be positive of that. I don't like the size of wave D compared to wave B. They're very out of proportion to each other. So that's a little strange, but the B wave is shorter than wave A, which allows you to have the D wave bigger than wave C, but it's just so extreme, makes me uncomfortable. The E wave is a little bit bigger than it should be in relation to wave C. So I don't know how reliable this data is, but where's it coming from?
It's called globalfinancialdata.com.
What is it? Consistent? What is it?
I do remember, I mean, I borrowed from a house in the early 80s. Was it early? I remember it being at 15, 18% in the early 80s for the US. So, yeah, sorry, late 70s, early 80s. The interest rates were that high. So I do know that. And I do know they flooded the market so that there was, the government was effectively borrowing a lot of money cheaply. And lending money cheaply around World War II and after that.
Yeah. Now you think this is sort of a strange statement, since I have been, by Timer Digest, the best bond timer for like the last 10 years for a long time. So it's going to be a little weird when I say that I think it's very difficult to predict the bond market. And a lot of it doesn't make a lot of sense to me. You're dealing with limits here. You know, you're not dealing with a market that can go to the sky or go down to zero. There's a limit to how high and how low it can go. And if it goes up to say 50 or 100, well, then the currency is probably destroyed and nobody's going to use it anymore. So there has to be a point where it can only go down so much and only could go up so much, which is sort of antithesis of good wave development, where it should be progressively going up or progressively going down. And you can see that's not doing that here. It's just constantly going up and down and up and down. And it's a little wild and gyrating. So I'm really not sure, what this means. It doesn't make a lot of sense to me. So I'm sorry, I can't really give you a good opinion on it.
No, that's cool. That's cool. That was good. It was nice to see you going through your thought process too. I don't know how many other people agree. I'll now hand that back. And I think we're close to the end. This has been a marathon effort, Glenn. Thank you very much for that.
That's been a lot longer than I expected. It's an hour and 40 minutes.
Okay. Have we got any other questions? I'm going to try and get out of what I'm doing here, whatever I'm doing. Meeting controls. I'll stop my share. and then hand back
Okay.
over to Glen, and maybe we'll just wrap it up if we've got any more questions. Glen, is there any final words you'd like to have? Max is saying, I really enjoyed the Bitcoin crypto chat. Max?
Yeah, take a look at Tron. Tron is
It sounds like we've lost your sound, Glen.
all crypto right now. Fees very efficient. It's not like Bitcoin that has high transaction fees and very inefficient and using older technology. So there's a good chance that Tron is going to start to steal a lot of business from Ethereum and Bitcoin. And it's moved up quite a bit lately, and it looks like there's potentially a move to $5 or $10, and it's only at 15 cents right now, or 13 cents.
Beautiful. Thanks, Glen. Okay. Looks like there's no more questions. I really appreciate the time you spent, Glen. That's wonderful. And yeah, thank you very much. Give us a clap. Okay. Thumbs up for Glen. Still there. Thank you very much.
Maybe one of these days I'll make it back to Australia.
And Glen's website is NEoWave.com.
Right.
And he's in California, so if you need ever to get a hold of him or his people, do it in the mornings our time. And yeah, as you can see, Glen is.
So I do have people all around the world. So Magellan's in Spain, and Terrence is in Australia. So you can write to Terrence at NEoWave.com for computer stuff, and to Magellan about sales and products and services. And that's Magellan, Magellan, Magellan at NEoWave.com.